Today on the show, I'm joined by James Millard from Sufficient Funds. James, welcome back to the show.
Thanks, Glenn.
Now, the other night at our live event, we had a case study and I gave, I think, 4 or 5 different advisors, mortgage brokers and John Pigeon, the property guy, 5 minutes to say what they would do. Not enough time.
Short and sharp.
So the rest of them, they'll send a Loom video in with some details of their strategy that we'll put up. But you're in Newcastle, so I said, look, come down and we'll spend half hour or so to give it the detail it deserves. Before we get into it, who is Sufficient Funds? What do they do? And thanks for your support with all our listeners that have gone your way this year.
Yeah, and thanks for sharing those opportunities with us to help your community, because we have financial planning and we have mortgage broking. We work almost entirely with under 50s. Our average client is about 35. And so lots of planning around that, and then just bringing the money plan together. And if they need some help with the mortgage, can do all of that as well.
Yeah, sweet. So we'll get right into it. So the current situation, and if you're on YouTube, you'll see this on the screen. If you are driving or whatnot, we acknowledge that not everyone can see this and listens only to the podcast. I'll try and explain it as clear as possible, and we'll put links to the YouTube in the podcast show notes as well, just so if you need to go back. I made this case study up, and I would make a good uni lecturer, James.
It's a very good case study, Glennie.
And remember, James, there are no wrong solutions, but if they are, I'll let you know.
Please do.
Yes. Okay, so Sam and Olivia Harper. Sam's 36, Olivia is 33. They're in Brisbane. They've got 2 kids aged 5 and 2. Sam's in sales, $170K a year plus super. Olivia works part-time in admin, about $46K a year, 3 days a week. Full-time equivalent for her is $77K plus super. Next year, Olivia may add 1 more day as Sam's parents are retiring in February and are happy to help out. The home is valued at $950 to 3-bed, 1.5 bath brick veneer outside of Brizzy. The block's 800 square metres, and they don't mind the location. They may outgrow it though, the house.
Super common.
Yeah. The mortgage is $610. They've got a variable rate at the moment at 5.97. They've got 2 everyday card account for day-to-day expenses. Their pay goes into each one of them. They've got $18,500 in cash. They've got another account that they've got money for kids of $2,000. Sam's got super with ART in the high growth with default insurance. Olivia has $48K in Aware Super Conservative, fixed death and TPD amount of $500K. The only reason I chose ART and Aware Super is because both of those companies have supported the podcast this year. So there's the disclosure. They don't pay for stuff, but hey, if you help out
you might get your name in lights.
You might get your name in lights because, we pay and we've got team here and, yeah, a bit of soft benefits there. Investments, $4,800 in raise in Olivia's name. Debts, $4,200 in credit card, 18% interest, trying to pay off a little each week. The car loan of $22K, it's a Mazda CX-7 worth around $32,000. Sam has a work car. And basically they've come to the advisor, they've filled out an online form and they've basically made some of these comments. There could be a $200,000 inheritance from Olivia's nan within the next 12 to 18 months. They want to pay off the home loan faster. They want to potentially look at refining to pay off the car loan. They want to keep adding to the raise account. So obviously investing is a thing for them. Olivia is concerned that her super is growing too slow and might get eaten by fees. They want to decide whether to invest the inheritance into shares or property, but they're kind of parking this now and might revisit later, not sure. Build a long-term strategy for school costs. They're looking at private high school. And they heard potentially about setting a self-managed super fund up to buy a property. They're interested in this. And they want to get organised and feel financially in control because they're feeling a bit financially stressed. Now,
Not uncommon, unfortunately.
No, and I think there's a lot going on there, and the reason I made it that way is on purpose, and I'll explain, and we'll get into James' solutions right after this. Before we get into it, this show is general advice only, and I've got a license to provide that advice. Full details can be found in the show notes. I'm a former financial advisor. Now I do the Money, Money, Money podcast. If you're a regular here, we call it M3, and we do a podcast called Retire Right. I've got a book, The Quick Start Guide to Investing, is available wherever good books are sold. There's a link in the show notes if you want to turn up your investing to 11, or if you're just getting started. Let's get into it. Thank you so much for being here today. Okay, so the reason I kind of made it this way, James, is I see a lot of people who reach out for financial advice who have like decent incomes, but also they're carrying a credit card. It looks sloppy, and I think as well with the young kids, one of the reasons I just want to add that, and maybe you can speak to it because you've got young kids as well, that 0 to 6 years old or 0 to primary school, it's a mess in a lot of areas of financially scheduled time. So they're kind of getting through that, and it's okay if things feel a bit out of control.
It's one of those times where you often feel like you're treading water, and it's okay. Is the message to most of our clients. Is like, you're going to feel like this might be the tightest time you've ever had, and it's the time where there's a whole bunch of moving pieces, a whole bunch of variables in your life, not only the money side of things, but just trying to keep things going properly. We left our 20s when you'd save for one thing at a time, you'd have a holiday, you'd get married, or you'd do something like that. 30s, generally, if kids are in the picture, the mess is pretty much standard.
And, they do have a property. There is equity in there. And I've kind of done it so maybe in their 20s, they actually really worked hard, got dialed in. Yeah. Maybe Sam had a higher income then. Olivia maybe too. A higher income then. And I think that's what happened. People have these big run. Awesome. Got the house. Awesome. Doing well. Babies come. Everything explodes, and now the credit card's crept in and things are a bit...
Things can slow down. Yeah. But I think when we dig into this one, you find that there's still a heap of opportunity. And often it is, hey, we feel like we've slowed down, but did you also give up? And if you're just being a little bit ignorant and putting it behind the couch and under the pillow and wherever else and not really thinking about it, well then you're not going to take the opportunities that these guys have. They've got $13,000 a month coming in.
Yeah.
And their expenses aren't that huge from what we're seeing.
Yeah. Now, I asked, as part of the case study, I wanted you guys to pretty much say what questions you would ask them, and also tying into that, what assumptions have you made, what is your strategy, and how did they benefit from your advice. So we might just throw this up at the screen. There's a lot there if you're watching on YouTube. But for those listening, do you want to talk us through all these points? Because there is a lot here.
Yeah. So that the DS defining sufficient, where we start with this is we have an initial call with anyone who you might send or someone introduces. We get a lot of client referrals, that type of thing as well. And we just want to work out, can we help you or not? And if we can't, we'll certainly point you in the right direction. But if we can, then we're exploring this next session where we call it defining sufficient. We're going to ask a whole bunch of questions and probably a lot more than you see on this screen right here, and to start to dive into what's going on, what makes you tick, what are your values, what are your goals, what are all the things coming up, so you can really start to map out life before you then bring the plan together. And so all sorts of things like the behavioral stuff. So we talk about the credit card debt. And if you have a credit card debt, did it creep up over time? Was it a one-off purchase that you're about to pay off and you just put it in the questionnaire because we thought, maybe that's all right?
Yeah, and that's kind of, I'm glad you said that, because I wasn't thinking, I was thinking more they got sloppy and it was death by 1,000 cuts. But you're right, they do have cash. And but why are they also, we want to pay it off? Because I think that's the psychology. It's like, no, we don't want to see our savings go down.
Don't want to see the savings go down, and this one's a little bit out of sight, out of mind.
Yeah. So anyway,
So yeah, I mean, maybe that gives us an indication of their spending, and we've made the assumption there that maybe they don't have control in one way or another there. Is there an emergency fund in addition to these cash savings? And why we ask that is often listeners from your podcast are so clued into their situation that they've already got the emergency fund and they don't see that as money. And so if they're telling us they've got 18 grand in the bank, which they have here, maybe that's on top of the emergency fund. So we were going to actually make that assumption.
Right.
And then how much is saving each pay? And really importantly, is it consistent? Sam's in sales, and that tells us he's probably got a base plus commission. And so we're going to make an assumption around there that is the case. His commissions are consistent, and he's saving about $1,500 a month. But as we know, they're feeling a bit stressed, and we know that they could definitely be saving more than that.
Yeah.
Then we're going to ask about private schooling. This is a big goal, and depending on where you're living, if they're in Brisbane and they're thinking about the top echelon of private schools, you're in the 40+ thousand a year now,
Which they wouldn't afford based on their salary. There's no way that you could afford.
Right now, it's a massive stretch.
Like
it's not going to happen.
It wouldn't happen.
But they're 10 years away, and so we wanted to ask about that. Is it flexible? And then therefore, what's the savings for the kids?
And this is the thing as well. Like if they did want the top of the top, and they're thinking, well, maybe Nan's inheritance might come through, this 200 grand is still going to go fast with private school.
With that, yeah.
And I think from my anecdotal experience, the private school fees, it's one thing, but it's all the other stuff.
Absolutely.
Are they doing fencing? Are they doing Latin class after school?
Are they going to Europe every second year on an excursion?
All that stuff. Yeah. So
big time.
So again, it's good they're thinking about it.
Yeah. And so we've made an assumption here that private schooling is actually something that the kids' grandparents are considering helping them out with. So they're pretty set themselves, and maybe they need to be talking to retire rights community there about what to do. So any other big spending in the next 6 to 12 months? So just really getting clear on, you've got some cash there, but does it need to go somewhere? Have you got to fix the fence? Are you going on holiday? We've made an assumption they're going to go to Fiji. So they're taking the 2 kids, perfect, quick holiday, but not cheap, 10 grand. Are they considering having more kids? This is one of those interesting ones. It's always the hardest question when we're thinking about.
Because to minimise the disruption years, the youngest is what, two?
So you've got 5 and 2.
It might be happening soon if they're going to.
Yeah, if it's on the cards, maybe this is the time. And so the answer for these guys was they're actually not sure. And so if we make the assumption they're not sure yet, it just changes how we approach some of the planning conversations with them. And from that, are they happy to stay in their home? And where we say that's a 3-bedroom house, they're probably going to outgrow it in about 10 years, if not earlier.
If not 10 minutes.
But another kid changes that big time.
Yeah.
Right? So that's where that consideration of the inheritance and what decided to do with the inheritance is just kind of park that for a second, because that's a fair bit of money, but it could go very quickly if you put it in the wrong spot, and it might stop you doing all the other things you want to do. And then preferences around investment. This is one of those things where it's really interesting to understand.
One of them must listen to the podcast, because it's amazing that they said they want sector exposure and small cap opportunities.
They've been listening to Vince, I think.
Yeah, absolutely.
So that's where, this idea of, we often meet clients who are educating themselves and they will have some sort of preference. Often they don't, and that's okay as well, but we're just asking the questions. We're like, explain what passive investment means, explain the idea of active. Is there any interest in either? And then what does that look like? And we'll always tell them what we think, but good to get the views.
Yeah. Now, some other hardcore assumptions.
Yeah, so we talked about inheritance. It's a little too far away to be getting too excited about inheritance. And I guess the other thing about that is Nan's still alive.
Yeah.
And she may have
kicking.
Very much kicking, we hope. But if they're saying 12 to 18 months, I mean, maybe she's not, and we don't know. But there'll be strings attached to these types of things in terms of an inheritance. So
maybe
Maybe.
There often is, but there's also often there often isn't as well. And I think I'd probably say potentially loose strings.
Loose strings in this case, probably.
Yes.
Yeah.
Maybe.
Yeah. We've had some clients where, especially if they haven't bought a property yet, there's often a
loose string.
This is where it's going. You need a house, and I want you to be stable, and often that drives it. But in this case, I think you're right. It's probably a bit loose, and that's okay.
Yeah.
But also, it's not definitely coming.
Yeah.
And so then Olivia is a long-term investor. We've made that assumption. She's happy to take some risk, and that's a really important approach to a conversation, is understanding that, exploring it, and seeing what that means. What is your tolerance as an investor to risk? And you might not know that. And even if I said, hey, do you take risk? Often a client might say yes or might say no, I'm really risk averse. But once we start to dig into that with some fairly simple questions, all of a sudden you realise they've got time on their side, and they've got a fairly moderate to high tolerance of risk because of that time, and therefore we're then checking things like super and any investments and how they set up. And then another assumption is the car loan. They've had that for a few years now. There's only a couple of years left, which is neither here nor there. For most car loans, you're probably not racing to pay it off. Once you've got it, you've made that call, you're in it.
Yeah.
And but in this case, the car loan isn't going to cost them much if they just keep it rolling and then they move on.
Often, if you do have a car loan type debt, I think it's actually worse to consolidate into the mortgage, because then you're just kicking the can down the road. I'd rather them sell the car and buy a $10,000 car and not have a loan.
If they can't afford it.
Yeah.
And then in this case, maybe there's some tax benefits there, although Sam also has a work car.
I would imagine
probably
it's
not.
But yeah, and I just put it in there for the lols. Now, we're going to ask your strategy right after this.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au. And they'll point you in the right direction.
We are back. So what's your strategy?
So I think for one, we've got to step back and say these guys have highlighted some challenges, and one of them is they're not feeling financially confident. They're a bit stressed and unorganised. And often what that tells me, and this goes beyond what a lot of financial advisors will do, is getting stuck into the weeds a little bit at the foundational level with what we would call a spending plan.
Yeah.
And really it's about directing your money, understanding what does it cost to be you. So that dirty B word, the budget, we're going to work through that and just understand how much is their cost of living. And if we map this out, then we're going to start to categorize that a little bit. Splitting a simple way of doing this, and we call this the declutter process for our clients. They're defining up front and then decluttering. And the declutter is the categorizing, splitting the fun from the boring. Where does your money go? How do you set up your accounts in that way? And then automate it. So that, and when we see this take shape, one, we see the client's eyes just completely light up, because all of a sudden they realize, money is a stressor, but it's not necessarily your super fund when you're 30 years old, right?
Yes.
It's nothing else other than the day-to-day.
Yeah, in
and
the
worrying
trenches.
about not being able to achieve what you want.
Yeah.
And so if you nail this initial system, the system is what allows you to really lift above and then shoot for the moon with your goals.
Yeah. Now, you've mentioned here 7 years of projections. Why 7 years? Why not 2? Why not 30?
Yeah, good question. So we think about these guys in the early mid-30s. early to mid-30s, and they're kind of thinking about another child. There's 200 grand dropping in their lap at some point in the next couple of years. There's a lot going on. There's a lot to plan for. And one of the hardest things about making big financial decisions, and that's investing and super and all of these other things that matter, or even just trying to figure out where do you direct what you're not spending, is understanding the impact of those decisions. And so a couple of years of projections doesn't give you much of an idea of where's that going. We'd look at their cash flow and have their budget mapped out over the next 7 years or so. You could even probably go to 10, to be honest, but I'm not going to 30. And 30, I mean, as soon as you get past about 5 to 10 years, really, you're fraught with inaccuracy already because of all the potential changes. The fact that inflation will change at a different rate, you'll be paid wildly different, cost of living's all over the place.
So I've accidentally copied your notes. That might not make sense to some people. More detail in the video I recorded of this. I guess this is the video. So you're saying get the spending plan happening now before the extra income comes.
Yeah.
So we know what it costs us to live now, and that extra income we can then actually put it to work or achieve some other goals.
And so Olivia is now that these guys are in a position where they could be saving more, and they're saying that. And so that tells us straight away, you need to get this in place right now.
Yeah.
And naturally, with a good structure and clarity over what you're spending and just revisiting it, it's not every month, even every 3 to 6 months is enough to have a look at this again and say, well, are we still spending on these things? And naturally, you're not earning any more, but you're keeping more.
And I think what I was going to ask on the projections, would you maybe run a 7-year projection and say, look, if you did have another child and took 6 months off work, here's the impact in this scenario?
Yeah.
But it's because you don't want the money to stop people having a family.
You definitely don't want the money dictating the situation. So I would err on the side of caution there. And so when we're doing that session up front, we're asking about this, I would really try and get a little bit clearer. So if you don't know, are you on the fence because you're not sure if you can have another child, or is one of you saying yes and one of you saying no? Where is that really up to? Yeah. And should we project that now, or do we wait until next year and maybe we're doing a full annual review with them next year? Then they've got real clarity over the inheritance as well as maybe some more clarity over the child side of things. You just have to make sure that the plan is flexible enough now to be adapted.
The 4 stacks, talk to us about that.
Yeah, so this is when we think about strategy, it's, okay, we've got the spending plan, we've got how much you should have left over. Strategy is then, well, where does it go? And so when we think about that, this comes down to the 4 stacks, which is very simple for us. 4 stacks of sufficient funds. Debts, are you paying off the home loan, paying off the credit card, those types of things. Savings, how much stays in the bank? Everyone needs a good emergency fund. Maybe you get a Fiji holiday that needs to stay there in cash. That's not being invested. That's not going to raise. Then it is investment. Are you channeling something to something that will grow faster than the money in the bank? Have you got the time frame for that? And if you can invest, should any of that be going into super? And often with these guys, and really for these guys, they've already got a few of these in play, but I would argue that all 4 of them are really important. Okay,
so what are the TLDRs on the car loan, credit card, and home loans?
So kill the credit card. Immediately, that's going to save you about $750 a year in interest, which is wild. So we get rid of that. The car loan, no, we're not going to get rid of that. We're going to, like we talked about, just keep paying that. Let it run its course. The home loan is at a slightly high interest rate, nearly 6% at the moment, where really they probably should be at 5.3 or 5.4. And so, they could save another $4,000 a year by getting the interest rate at the right level there.
So just talk, if any of your advisors came across this, you would refer them to one of your brokers just to run their eyes over it? Although they would know if, because I did this rate kind of a little bit on purpose to say that a lot of people don't review their rates and their products for a couple of years. next day you rock up, it's like far out. We could be saving like almost $100 a week by reviewing the
for
rate.
Sure. Yeah.
And
the
look, mortgage.
We're not ever out there to steal another person's business. So if they have a home loan, we would ask them if they've got a broker and are they stoked on their service.
Yeah.
And if they are, great, go and use them. But if not, absolutely, we've got a team in place that can jump all over it.
Yeah.
And we know they'll do a great job. And so we've got an opportunity there to save them a bit more. They're separate businesses because of licenses and how it all works, but they're internal so we can share information really quickly and easily.
Yeah. Awesome. You've noted that the emergency fund is pretty much stocked.
So they've got a stocked emergency fund. We've said that they've got more in the bank. That's the other 18 grand on top. And so if they pay out the credit card and then they have Fiji covered, there's still a 4.5 grand sitting there that we can do something with.
Yeah. Would you ever say like maybe chill out on the holiday for now? You can't afford it, or you can at the expense of this or that?
So I think where this conversation really went was you guys can save a lot more. You can absolutely do the holiday, but we want to see you smashing your savings at the same time.
Yeah, cool.
Yeah.
All right, talked about raise.
So raise fees-wise is actually not as bad as it used to be. They used to be the $5 grand. That's actually not too bad now. Even if they went a bit over $5,000, it's not a problem until you really get up in the 20s in terms of that. There are limitations around the investment options and that type of thing, which may or may not matter depending on the client. So for these guys, we're just parking any action on raise right now because the big thing will be what you do with the inheritance. And maybe there's a much bigger kind of discussion and bigger plan around your investments at that point.
Yeah.
That could be something as complex as something like debt recycling if it made sense for them. But, there are a lot of other variables here at play in terms of home upgrade and kids and stuff before we go anywhere near that.
Yeah. Investment bonds for kids' savings.
Yeah. So the bond option, it works quite well. Bonds have a capped tax rate, but often, especially at the moment and in the last few years especially, the rate within a bond is much, much lower than the 30% that is advertised as their cap in terms of that, and can work really well. These guys, in our discussion we worked out before, they're not going to be funding private schooling. So you can, if you were going down that path, there are specific bonds that might be purely for school and there's some extra tax benefits if it goes to education. But in this case, a bond is a good product where you're able to pass these products to your kids without having to change ownership in the future. And so there's some really cool benefits there. It's also a great kind of set and forget automation. There's lots of rules around this, so please don't go and act on this without talking to an advisor, but lots of rules around how you play them and make it work for you. But in the end, they sort of said, look, we want to gift $30,000 to our kids when they're, at least maybe around the 20-year-old mark. And so $1,000 in and $100 a month at a half decent investment return over 15 years will do the trick for both.
Yeah, right. Interesting. Super.
So Sam's they're both in industry funds at the moment, and industry funds are known as what's called a pooled fund. And there comes a point in time, and the balance is probably when you're hitting around 75 or thereabouts. Some advisors might argue it's even lower than that, but somewhere around that point where the benefit of moving into a platform or what's called an IDPS, investor-directed portfolio service. It's not a pooled fund. It's where the individual tax consequences apply, and this is a little bit complex. So we'll keep it high level, but the tax savings that you would get from that over the longer term.
Yeah, but we're talking 30 years.
Talking 30 years, so a lot of time. So the longer you have, as long as your balance is at the level that it makes sense, because the fees might be a little bit higher to move. Not always the case, depending on where you're at and what your investment preferences are and all of that type of thing. So, our team would always, any good advisor will always do a full review of fees and everything else, tax on top of that, to then consider, is there a benefit in moving that? And if so, what does that look like? And often, in Sam's case, you're probably talking somewhere at least around the 5% of his retirement balance once he hits retirement. And, over the next 25 plus years, that could be huge.
And why are we doing a concessional contribution for Sam?
So there's a couple things here. So one, Olivia's concerned about her super balance.
Yeah.
They've got $4,700 left in that cash amount that they said they had that they really don't need right now. And we've got a heap of changes coming up probably with this extra inheritance that's coming in a year or two. But right now, that's extra cash that they don't need for anything. And I just love for them at their age doing something in terms of super. Now, why would we put that into Sam's super fund rather than Olivia's? Firstly, when we say concessional, that means pre-tax. So it's going in before tax. So Sam earning more and paying more tax saves more tax when he contributes to his fund. But then we get to do a split of the contribution from his to hers to Olivia's, which then allows them to start to build up her fund at a much more rapid rate.
All right. Self-managed super fund.
Yeah, excitement plus. And we often get clients who will ask about a self-managed super fund because they heard about it.
Yeah.
It's blasted on Instagram or the accountant might have brought it up. There are some fairly limited reasons why you might look at a self-managed super fund. They're expensive. The burden of compliance is now on you rather than the fund. And commercial property might be a good reason for it. But if it's not that, really, a good platform or an industry fund can do basically everything you ever wanted to.
Totally.
And much cheaper.
You would run your eyes over the insurance because I think they're both definitely underinsured with the default cover.
Yeah, there's no need. There's no doubt that they need some more cover. It's just always a bit of a balance around can they afford it and does it fit within the budget? But really, that's a high priority.
Yeah.
And so we'd be doing a full workup, looking at the needs, how much they need, what do they think is important versus not. And then that's things like life insurance, probably because they've got kids, TPD, total permanent disability. If you're unlikely to ever work again, having something there to see you through, cost of care, that type of thing. Trauma cover, which is, cancer, heart attack, stroke. Unfortunately, it's the one that we're probably claiming on almost the most with clients, even our young clients.
Yeah, it's wild.
And income protection, which is the most expensive because it's the most commonly claimed upon.
But it's tax deductible.
And it's tax deductible if it's in your own name, so super important.
Wills and estates.
Yeah, and so wills, powers of attorney, with these guys with kids especially, they'd want to be thinking about guardianship. And so who's going to look after the kids? These are all the toughest conversations and decisions with your extended family that you're ever going to have. Advanced care directives, those types of things. There's also an opportunity potentially to look at a testamentary trust. Those aren't cheap, but they can be very valuable. That's just making sure that if you were both to die, there's a way to hold assets in trust that protects, especially from future partners if relationships with the kids when they're older go south.
Yeah. Inheritance future strategy.
So if they have another kid, they're probably going to need to upgrade the home.
Yeah.
And we touched on that already. If they don't...
I don't know if anyone's touched on it, but in the case study, I put the 800 square metre block on purpose and on purpose that they like the area. I reckon we renovate it if it's in the right primary school zone because you've got a freehold block that you own already. Throw 300 grand at it. There's probably 150 of equity that they could pull out to renovate the house.
Yeah. And this is where it comes back to when we're thinking about these investment opportunities. Like if they really wanted to buy property as an investment, they've got equity to do it.
Yeah.
And they don't need to put this cash that they might be having come towards that. So then they've got that option.
But surely with a growing family, you'd really want to nail the living situation before we worry about
big time
doing wholesale type investing.
Big time.
When I say wholesale investing, I don't mean
The
like
big stuff.
the guide. I mean like
shares and property.
Well, before we start throwing $1,000 a month at something.
Yeah.
Like, no, let's go back and see, okay, do we need to renovate the house? Do we need to upgrade the house? Do we need to move and upsize? All right, we need to get that done now. Then we can worry about building wealth.
Which is exactly why kind of where we're at right now is we don't know for sure. They might not need it straight away. Are they going to upgrade now or are they going to wait and do that in the future? If they've got 5 or 7 years, maybe their risk tolerance is high enough to be investing the future home upgrade fund. But if they're going to have another child and they need to go soon, then 4 bedrooms, convert something in the new home, make it a bit bigger, you've got the block to use it, then maybe that 200 would help if the inheritance comes through in the next little bit.
I don't know if you heard the other night when we were talking about this, I originally was going to get all of you to do a 5-minute thing of what you would do. And then I was going to get Martin McGrath up from Financial Edge Group, who hosts the Retire Up with us, and go, he's doing a case study and it's actually Olivia's nan. And we did the case study how she doesn't have the $200,000 to give. Yeah. She was misguided with telling people she was going to do an inheritance. And all that to say, when stuff's out there 12 to 18 months' time, we can't put the house on it because it might not come.
100%. Yeah. Martin probably needs to look after the parents of these guys too if they're retiring next year.
That's right.
And he's got a few opportunities coming
his way. All right. Okay, so how did they benefit from your advice?
So we get asked all the time, I mean, what is the value, right? Because investing in financial planning is not cheap.
No.
Right? It's always in the thousands, not the hundreds, to go through this kind of big process. And there's a lot to unpack, and the time that it takes us to deliver that, you need to make sure, and we need to make sure there's going to be solid value. So we kind of think of it in 2 ways. One, and everyone knows this, you've got to make the money back, right? A lot more than what you spend. In my view, you should be making a lot more than what you spend back in advice to go through the process. There's time involved as well.
Yeah, I don't know. I would challenge that a little bit, because I'm thinking if I'm spending, say, $6,000, whatever the cost is, Retire Right client specifically, because we talk about this a lot. If the advice was $6,000 or $7,000 up front, there often is a hard tax saving, or a hard saving throughout the next 12 or 24 months that it will pay for itself. But I think you're allowed to say, well, even if we carved off $3,000 of that amount into this category of making sure we're on track, making sure we're not doing the wrong thing. And you've got a comment here about the clarity of not doing the self-managed super fund, like literally being told not to do it.
You didn't do anything silly.
I just think the part of the advice fee is a good emotional and, I don't know, factual guardrail.
Yeah, and I like that. And that's where we go. There's financial benefit, and then there's all the intangibles. Yeah. There's that feeling of knowing that you're on track. If we think about the financial side of things, there's straight away you've got this spending plan for us. We could see with his earnings there, and with our discussions that we're making assumptions around, there's a really clear probably $700 or $800 a month that they could be keeping.
Right.
They've got 10, 13 grand after tax coming in every single month, and the mortgages are about 3.5 or so. There's a bit left over there, and I reckon they could probably be squeezing another $1,000 a month out. Now, this isn't us going to Sam and Olivia and slapping them around and saying, no, you can't do this and you can't do that. It's just a structure.
Yeah.
And so often we find, like when we think about that value, that spending plan at the very top paid for the plan in the first 12 months.
Yeah.
And then beyond that, it's like, well, where does this all go? Well, then we've got the interest from the credit card. So paying that $4,000 odd out will save $750 a year on top of that. There's the efficiency around investing. There's the tax side of things that they'll get out of that. Moving Olivia, and we didn't touch on this earlier, but moving Olivia to a higher risk growth approach within her super is going to make her thousands and thousands over the years. So there's that part there.
I mean, if you were moving her to an IDPS, moving him, would you not just for housekeeping move her as well, or
maybe? And that's a question we'd ask them around convenience. Like, do you want to just be in the same spot? Is it easier?
I'm also thinking, like, as the accounts grow, the combined
there's
fees.
The aggregate balance. Yeah. So often we can do that family linking.
Yeah.
But you got to really look at that and see, well,
but there's no
how much
stress with leaving people in their funds if they want to stay. It's like, yeah, sweet. Knock yourself out.
Yeah. Doesn't matter to us. Our job is giving advice in your best interests.
Yeah.
And that's all we're doing. We've had a big discussion with you. We've talked through this. We've had a number of meetings. We feel like we know you, we get you, and we should be delivering advice that you look at and go, yeah, that makes sense, let's go.
Yeah.
But if for some reason you look at it and go, you know what, I just want to stay there for a bit, that's cool. No stress.
Yeah.
And so, yeah, then there's the tax saving from the super contribution. So Sam gets $1,800 personally there, but $1,100 after tax net because there's a bit of tax when it hits his super fund.
Yep.
And then there's like we said, that massive saving of actually not doing the self-managed super fund. And we can't quantify that, but it's probably potentially pretty significant. And then there's these ideas of the intangibles. So it's, the confidence, the clarity, the simplicity now, all the weight off your shoulders.
Yeah.
And really, really importantly for Olivia, her super fund balance grew by $20,000 and she didn't have to contribute anything to it.
Yeah.
And all of a sudden she's feeling like things are a little bit more equitable. But for them, both of them, there's some big tax reasons to balance your funds as well over time. So that could really set them up for the long term.
Sweet. Pretty comprehensive, a lot longer than 5 minutes on a live podcast where half the audience had 50 beers by the time we got recording and pizza and gelato.
And if they didn't, they took them with them.
That's right. There's this new theme now. Any leftover alcohol from our events, people just leave with them, but that's fine. So in terms of hardcore tangible money, like how much do you think they got in terms of value out of the advice?
So an easy 15 to 20 grand.
Right.
And that's probably after the fee they'd pay us.
Really?
Yeah. And so that's the tax savings. It's the extra funds in the bank from just keeping more of what they're earning.
Yep.
And most of that would show up fairly consistently year on year.
Yep.
So, I mean, if you think about it, you zoom out and go, well, let's say 10 grand of that is ongoing savings because they're just more on top of their stuff now. That 10 grand over 20 years compounding at a decent rate is $400,000.
Yeah.
And so before they get to retirement, there's the house upgrade fund or the very early financial freedom fund or whatever else it might be.
Yeah.
Or if they get to retirement, it's $500 extra a week that they could do something with.
So with your advice business, you can, you're better suited to higher income earners?
So these guys probably land pretty close for them just cracking like 200 grand between them.
Yeah.
As a couple, anything over about that, it starts to bring up these opportunities where there's a bit left over and we're going to help
do
them
stuff with.
dictate or direct it. And that's where we're looking across those four kind of stacks, debt, savings, super, investments, because there's always opportunities there to just tweak them a little bit. Sometimes there's some huge wins. Sometimes there's some massive wins where they're thousands and thousands of dollars in return immediately. Other times it's, hey, these tiny tweaks are going to set you up big time for the future. And, often it is, hey, we're about to have kids or we're about to do this and we're thinking about these big decisions or we've just got this inheritance or we don't know what to do with it.
There's probably an argument as well, like if they said, we are actually going to have another child and we're trying to fall pregnant, half of it is like, I don't know if it would be worth pulling the trigger fully on advice. It's like, well, clean that credit card up, do Glen's free spending plan and try and at least tread water. And once you actually got that certainty, then come back and I don't know.
Yeah. And so I guess you think about these guys and you've got that spending plan. So if we could help them keep, or, like you're saying, they could have if your spending plans kick them off on the right gear, they can DIY it.
Yeah.
And that's where we do find sometimes DIYing works really well. And we don't do a spending plan for everyone we work with.
Yeah.
Because we don't need to, or we don't always. Sometimes they're already on yours.
Yeah.
And they're nailing it.
Yeah.
Or they might have tried something and it didn't work. And then they're just like, ugh. Can you just tell us what to do?
Yeah, yeah.
And so often the value and that additional value is not just the weight off the shoulders, it's the motivation to get it done.
Yeah,
and it's the action that they take.
Awesome. Well, James Millard from Sufficient Funds. You can Google Sufficient Funds, reach out to James and the team. Bit of info on the website if you want to have a chat with a financial advisor, probably in the new year now, given that we're almost at the last week of school.
Yeah.
But thanks so much for sharing around what you would do with this case study and helping a heap of our listeners this year.
Thanks, Glenn. Stoked to be here.
All right, bye.
Cheers.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.